Characteristics of financial institutions. Financial institutions differ significantly from non-financial companies because their primary business involves managing financial assets and liabilities rather than producing goods or services. Banks, insurance companies, and other financial intermediaries generate earnings largely through interest spreads, underwriting activities, and investment management. Their balance sheets are dominated by financial instruments, making them highly sensitive to changes in interest rates, credit conditions, liquidity, and market volatility. Regulatory oversight also plays a much greater role in shaping operations and financial reporting. As a result, traditional financial statement analysis techniques often require modification when evaluating financial institutions, with greater emphasis placed on risk management, capital strength, asset quality, and earnings sustainability. Regulatory environment and the importance of capital. Financial institutions operate within extensive regulatory frameworks designed to promote stability and protect depositors, policyholders, and investors. For banks, the Basel III framework establishes minimum capital, liquidity, and funding requirements. Capital serves as a cushion against unexpected losses and reduces the probability of insolvency during economic downturns. Regulators require institutions to maintain sufficient capital relative to risk-weighted assets to ensure resilience against credit losses and market disruptions. Because excessive leverage can threaten financial stability, analysts must carefully evaluate regulatory capital measures and compliance with minimum requirements. Strong capitalization generally indicates greater capacity to absorb losses and continue operations during periods of financial stress. Capital adequacy and Tier 1 capital. Capital adequacy assesses whether a financial institution has sufficient financial resources to support its risk profile. Under Basel III, Common Equity Tier 1, CET1, capital is considered the highest quality capital because it consists primarily of common stock, retained earnings, and other comprehensive income. Together with additional Tier 1 instruments, CET1 forms total Tier 1 capital, which must meet regulatory minimums relative to risk-weighted assets. Higher capital ratios generally indicate stronger solvency and greater protection against unexpected losses. Analysts often compare a bank's capital ratios to regulatory thresholds and peer institutions to assess financial strength, risk tolerance, and the institution's ability to withstand adverse economic conditions. Asset quality and credit risk assessment. Asset quality is one of the most important determinants of a financial institution's stability because loans and investments represent the primary sources of income and risk. Poor asset quality can lead to significant credit losses, earnings deterioration, and capital impairment. Analysts evaluate asset quality through measures such as non-performing loans, loan loss provisions, charge-off rates, and concentrations of credit exposure. Effective underwriting standards and prudent risk management contribute to stronger asset quality. Deteriorating economic conditions often result in rising default rates and declining asset values, making asset quality a critical leading indicator of future financial performance. Continuous monitoring of credit risk is therefore essential for evaluating institutional health. Management capabilities and risk governance. Management quality plays a central role in determining the long-term success of financial institutions. Effective management establishes sound lending standards, capital allocation policies, liquidity management practices, and risk controls. Because financial institutions operate with significant leverage and complex financial instruments, weak governance can quickly lead to excessive risk-taking and substantial losses. Analysts often assess management through historical performance, consistency of strategy, risk-adjusted profitability, regulatory compliance, and responsiveness to changing economic conditions. Strong management teams are generally characterized by disciplined underwriting, prudent capital management, and transparent communication with stakeholders. Evaluating management capabilities provides insight into the institution's ability to navigate future challenges and opportunities. Earnings quality and sources of profitability. Earnings quality refers to the sustainability, predictability, and reliability of reported profits. For financial institutions, earnings are generated from multiple sources, including net interest income, fee income, trading income, underwriting activities, and investment gains. Analysts generally prefer earnings driven by recurring core operations rather than volatile or non-recurring sources. Trading income, while potentially significant, is often more volatile than interest income or service fees. High-quality earnings are supported by stable revenue generation, conservative accounting practices, and adequate provisioning for future credit losses. Understanding the composition of earnings helps analysts evaluate profitability and identify potential risks to future performance. CAMEL's framework and integrated analysis. The CAMEL's framework provides a structured approach for analyzing banks and other financial institutions. The framework evaluates capital adequacy, asset quality, management capability, earnings quality, liquidity, and sensitivity to market risk. Each component contributes to a comprehensive assessment of institutional strength and vulnerability. Capital adequacy evaluates solvency, asset quality focuses on credit risk, management examines governance and risk oversight, earnings assess profitability sustainability, liquidity measures funding flexibility, and sensitivity evaluates exposure to market variables such as interest rates and exchange rates. Analysts frequently use the CAMEL's framework alongside financial statement analysis to develop a holistic understanding of an institution's risk profile and financial condition. Analytical implications for CFA candidates. For CFA candidates, analyzing financial institutions requires a specialized approach because traditional industrial company metrics often provide incomplete insights. Particular attention should be paid to capital ratios, credit quality, earnings composition, regulatory requirements, and management effectiveness. Strong institutions typically demonstrate robust capital buffers, high-quality assets, consistent earnings, and prudent risk management. Conversely, deteriorating asset quality, excessive leverage, weak governance, or reliance on volatile income sources may signal elevated risk. By integrating assessments of capital adequacy, asset quality, management capabilities, and earnings quality, analysts can better evaluate the financial strength, resilience, and long-term value creation potential of financial institutions operating in increasingly complex financial markets.